Hey, what's up, my friend? So, in today's episode, I want to talk about how do you find an edge in the markets. So, what is an edge, right? An edge is something, right, that you do repeatedly, right, that yields a positive outcome, that yields a positive expectancy. And this is one of the biggest issue, right, traders face is that they are trading without an edge. It's not easy to find an edge in the markets, I'll be honest, because the markets are quite close to being efficient. But if you work at it, if you put in effort, right, yes, you can find an edge in the markets. And I'm going to share with you two, right, techniques that you can use today to find your edge. So the first technique is for discretionary traders. Discretionary traders, it means that you trade off using support, resistance, candlestick patterns, trend line, etc. Something that includes an element of subjectivity. It's classified under discretionary trading. And as a discretionary trader, here's what you want to do. First thing first, you need to have some experience in the markets. You have to identify certain patterns in the market that you realize that, whenever this pattern occurs, right, there's a higher probability of this happening. So you need to identify certain patterns in the market, and then you need to quantify that pattern, right, and find out whether it actually works or not. So the first thing that you want to do is, let's say you identify a certain pattern of behavior in the market, you want to develop a trading plan, right, around that pattern. That's the first thing. So developing a trading plan, what does it mean? It means, right, that you have to so-called quantify that pattern, right? Under what market conditions, right, would you trade the pattern, right? What is the exact entry criteria when trading the pattern? Where do you set your stop loss? Which markets do you trade? How will you manage your trade if it, moves in your favor? Using a fixed target profit, using a trailing stop loss, right? So all these questions, right, will go into your trading plan to so-called exploit the pattern that you have potentially find, right, and to see whether it works or not. So that's the first thing, right, developing a trading plan around the pattern that you have identified. Second thing, you must, right, execute those trades according to your trading plan, right? This means once you've so-called quantified the pattern, you have to trade it in the markets according to the whatever rules that you have set for yourself, executing your trades consistently. And this means that you can't deviate, right? You can't, like, let's say you're trading the breakout of 50-day high. The first 5 trades you trade breakout of 50-day highs. The next 6, 7, 8 trades you trade the breakout of 250-day high. No, that's not what it means, right? You have to stick to the rules that you've given yourself. If not, you'll just be fooled by the law of large number, right? So stick to your trades, execute it consistently, right? And execute a minimum of 100 trades, right, to get a decent sample size. The third thing that you want to do is to record your trades, right? Journal them down, right? Your entries, your exits, right? How much profit you make, right? What's your risk reward ratio? Write all this down and journal down your trade. And finally, the fourth thing you want to do is to review your trades, right? Once you have a sample size of 100 trades, right, you can find out whether, this pattern actually works or not. What is the win rate, right? What's the average risk to reward ratio? Which markets, has the most trading opportunities, yada, yada. And it's only through reviewing your trades, right, you can actually improve on things. Maybe you find out that this pattern maybe doesn't even make money at all, and you can move on to something else. Or maybe you find out that, hey, this pattern actually makes a profit in the long run. And however, right, there are certain times when this pattern does better than other times. Maybe it works best on, let's say, on a Wednesday and Thursday, and it doesn't work as well on a Monday. Or maybe you find out that this pattern works best in the gold market, the oil market, and doesn't work well in, let's say, the stock markets. So you can see that through your trade journaling and review, right, this is how you can actually improve yourself as a trader and find your edge in the markets, right? So the first thing, right, as a discretionary trader is to remember this concept I just shared with you. I call it the DER method, right? Develop your trading plan around the pattern that you have identified. Number 2, right, execute your trades consistently, a minimum of 100 trades. Number 3, record your trades. And number 4, review them to find your edge. So now, what about the other type of trader, systematic traders, right, who trade with fixed, rigid rules? How do you find an edge in the markets? So this is actually an approach, right, that I also adopt myself, both technique 1 and 2. But technique 2 is, I would say, in my later part of my trading career, where I started to move more into systematic trading. So technique 2, what I did is that I studied, right, traders who have found success before me, right? Systematic traders who are willing to share their rules and systems. So the best way to go about it is to read books, to study academic research papers. So just to give you a few books that I've read that have really helped me. Number 1, Following the Trend by Andreas Kleno. He also wrote a book on trading involved. You can check out Unholy Grails by Nick Rach. You can read Short-Term Trading Strategies That Work by Larry and Cesar Alvarez. Those are some of the books, right, that I've read that actually shared the systems and the results with it. But does it mean that, those systems are guaranteed to work and you should just trade them live? No, of course not, right? You should take those systems, right, and then ask yourself, right, why do these systems work, right? You need to ask yourself, what is the why behind the systems? For example, trend following. Why does it work? What's the logic behind it? If I can't come up with a logic, or if there's no reason that I think that it should work, right, I will not even touch the system at all. So for trend following, it's because, right, the market trends, right, because of fear and greed in the markets. Humans are primarily the ones, right, getting involved in the markets, and we all have fear and greed. When there is greed in the markets, it's going to be an uptrend, and trend followers, they can capture, a certain part of the uptrend. And when there's fear in the markets, trend followers, we can go short and capture the meat, right, of a downtrend. And that's why trend following work, because there's fear and greed in the markets. And once you identify, right, why a trading strategy or system should work, the next thing you want to do is to validate it. I never trust stuff that I come across, right? Even though there's backtest results, right? I never trust those results. I always want to do my own backtest and validate whether that trading system works or not. So this is where, you do your own backtesting, right? If you have programming knowledge, right, you test the system, right? If you don't have programming knowledge, right, find someone who can do it, right? Give them the rules, right? Maybe the rules that you get from the book, right? Give it to them and ask them, right, for the results of the systems, right? It may not be 100% correct, but if anywhere between 80-90% similarity, right, I would say that it's pretty much okay, right? Things are pretty much aligned my expectations. And finally, the last thing that I do, right, is I want to tweak the system, right, to my own preference. I don't just want to trade that system blindly, right? I have certain needs, certain preference. For example, trend following, right? Again, Andreas Kleno, I believe he talks about the medium-term trend following in his book, Following the Trend. Breakout of 50 days. 50 days, the highest close over the last 50 days, and 3 ATR trailing stop loss. For me, I don't want to trade such medium-term trend following. I went with a longer-term trend following. So I traded the breakout of the 200-day, right, highest close over the last 200 days, and I adopted a longer-term trailing stop loss to ride a longer-term trend. And you can see that this is how I made tweaks, right, to my own systematic trading systems. And the way I did it is by first, right, learning, right, from other traders who have come before me, finding a logic to the system, validating it, tweaking it, and then finally, right, trading it with my own live money. And this is how I find my own edge in the markets, both as a discretionary trader and systematic trader. You may not want to go with both approaches like me, maybe just discretionary trading or systematic trading, whatever suits you. But I hope fully, right, this gives you a good idea, right, to how you can go and find your own edge in the markets. All right. So with that said, I have come towards the end of today's episode. If you've enjoyed it, right, smash the like button, hit the thumbs up button, right, and subscribe to my YouTube channel. I will talk to you soon.